Hello, hello, my fellow financial analysts. So let us move into case number 5. We'll tackle the participation questions first. Case number 5, what are we really worth? And this is about valuing a company in terms of its equity, and also finding that would be the total equity value of a company, and then the equity value, the stock price per share for a company. So the first participation question is, what is the issue facing the company? And the company is at a crossroads, and they've been very successful to this point, but they need to take it to the next level. In order to continue to compete, they've got to continue to grow. And in order to grow, they need capacity. And the question is, how do they increase their capacity? How do they increase their capacity to manufacture? How do they increase their capacity to create new products? How do they increase their capacity to advertise? How do they increase their capacity to market to retailers to get shelf space? So their options include borrowing more money, so that would be bonds, or issuing stock. Right now it's a privately held company, 100% privately held. In issuing stock, they could bring on a private partner, or they could go public. Now, this particular case, they're limiting their options in terms of raising capital. They're not talking about issuing more bonds, but we'll take a look at their leverage. But they are talking about possibly going public, issuing stock to the public. They're not talking about taking on maybe a private equity fund as an investor. They're not talking about partnering with another company. They are talking about the potential of increasing their manufacturing capacity by outsourcing their manufacturing, which means that they could increase their ability to produce, but they wouldn't control the quality of the product, and they wouldn't control the cost of the product. Their margins, by outsourcing, their margins undoubtedly would go down, I would think, because they're working with another company that has to make a return. So I would think that the cost of their goods sold would go up for the company. So the owner of the company has looked at either outsourcing. One of the sons says, let's outsource, and the other, at least one other member of the family says, let's go public. And so they looked at it. The father looked at it. What's his name? Yeah, it's Matt. So Matt looked at it and said, let's go public. Let's think about going public. All right, so they're at a crossroads. How do we grow? All right, so investment banks and firms that are looking to make acquisitions always rate a company in the situation in which Citrus Grow finds itself as an excellent candidate. Why? All right, so Citrus Grow, there are two things about Citrus Grow that makes them an excellent candidate, either to be purchased or to do an offering. Okay? One is the fact that they need capital to grow. Okay? And so investment banks are in the business of providing capital, helping companies raise capital. Also, another issue that is facing Citrus Grow is management transition or succession. Matt is 70, how old is he? I think he's 75. Let's look through here. Yes, Matt is nearing 75. And so they're at a transitional stage. And a lot of times at a transitional stage, the next generation isn't as interested in the company as the previous generation, and they're looking for a way to make a bunch of money and improve the quality of their lifestyle without having to work more, and that means they'll sell themselves to another company, or they'll take themselves public. But either way, they're looking to do a transaction. And so investment firms are looking for companies where there's a transition in management, succession, and or they need to raise capital to grow. All right, so question number 3. There is one piece of information, make sure we're recording yet. There's one piece of information missing from the case. The author never mentions it. This may be the single most important factor in the case, but the author leaves it out. What is it? All right. So Matt talks about what their issues are. Lisa, Joe, and Dan, the kids, are talking about their options. Matt decides to explore the possibility of raising the money via an IPO. And now he says something that's weird. It's relevant, but it's incomplete. On page 55, at the top of the page, why don't the 3 of you put your heads together and figure out what is the minimum price that we should sell our stock for if we were to go public? Let's say we sell 30 million shares. I'm sure we can find a way of retaining control of a large portion of the shareholding and still raise the much needed cash. Okay? So Matt throws this number out, 30 million shares. Where in the heck did he get that number, 30 million shares? Let's look on the balance sheet and see see if they have how many shares outstanding. And they don't. Okay, it just says they have total owners, they have owners' equity. So we don't know how many shares are currently outstanding, but they want to sell 30 million shares. Where did he get that number, 30 million shares, and is that number relevant? And the answer is, we don't know where he came up with 30 million shares, and that number is not relevant. So what is relevant is how they need to know what the company is worth today, and they need to know how much capital they need to raise. And if they raise capital, that will increase the value of the company. They'll do projections for growth, assuming that they're going to raise capital. So here's what I'm saying. Let's say that they decide that they need to raise, I don't know, let's see what their net worth, let's see what their assets are. Look at their balance sheet. And their assets are, so they have total assets of $162 million. Okay? And let's say that they wanted to increase their sales. I think they said their sales are, let's go to the income statement, their sales $500 million. They've been growing pretty rapidly, about $100 million a year. And they would have to, if they're going to do something to raise capital, they probably need, so they're 500 billion, on total assets of 161 million. That's pretty good asset turnover. They probably would need to sell half the company. Okay, they probably need to raise about $80 million. Okay, about half the total assets. And I'm just looking to see what the total asset turnover is. Man, that's crazy. That's high. $80 million, which would be half of their total assets. Their owner's equity right now is $95 million. So in terms of owner's equity, you know, if they want to raise $80 million and all of it in equity, you know, they're talking about selling 80 divided by 95. So that's, you know, 85% of the company. But let's say the company, so let's say they need $80 million, and let's say we decide that the company, the market value of the company is $300 million, okay? So they have to sell 80 divided by 300, let's say it's 320, so 8 times 4, so that'd be 25% of the company that they'd have to sell. So they need to know how much capital they're looking for, and then they need to know what the company is worth, and then they divide the amount of capital that they need to raise into the market value of the company, what they think the company is worth, to determine how much of the company they're going to sell. And then they'll divide that. You know, you can always come up with the number of shares to come up. You can always come up with a price and multiples to determine what the stock is worth, and you can use that to sell 30 million shares. But the company would have to issue a bunch of new shares on the front end. For simplicity's sake, they might have to do a 1,000,000-for-1 stock split to create 1,000,000 shares of stock. Maybe there's 1 share of stock outstanding and Matt owns it. He'd have to turn that into 1,000,000 shares of stock, and then he'd have to sell, not 1,000,000 shares, if he wants 30 million, he'd have to turn that into 100 million shares and sell 30 million shares, which would be at 30% of the company, in order to raise $85 or $90 million. Okay, see what I'm saying? So what we need to know is how much is the company worth, and how much capital do they need, and they leave out how much capital they need. We can figure out what the company's worth today, assuming certain forecasts, but those forecasts assume capital comes in. But let's go ahead and start working on question 1, okay? But this is the piece of information that is missing. How much money do they need to raise, and what percentage of the company will they have to sell in order to raise that amount of money? All right, so let's go into question 1. What are the advantages and disadvantages of going public? Do you agree with Dan's concerns, or do you concur with the other members of the family regarding the issuance of an IPO? Explain why. Okay, so let's go back into, well, let's answer the first part. Advantage, disadvantage of going public. Okay, the advantage of going public is that you raise the profile of the company. People become much more aware of the company and the name and what they do, and that helps with marketing. Okay, it also puts the company on the map for other companies that want to acquire a publicly traded company. Okay, so there's a marketing advantage, there's a finance advantage. You take the company public, you raise capital, so there's an advantage there. So what are the disadvantages? 1, there is an upfront cost to issue stock and sell stock. So there are one-time charges associated with that, so it's expensive. You got to pay for accountants, you have to pay for attorneys, you have to pay for investment bankers. Okay. Then there are ongoing compliance costs. You have to hire people, either internally or engage them outside of the firm, outsource it, pay consultants to do all of your compliance work, all of your reporting work. So it's expensive in that way. You have to disclose a lot of information to the public, including your competition. Okay? And lastly, you don't own 100% of the stock anymore, and so you have to give outside investors input into important decisions that the company is going to make. So those are the advantages and disadvantages. And now let's look at, let's see, 54. Let's look at the concerns. Lisa and Joe strongly supported the idea. They felt with competitors coming up with substitute products, they needed to stay ahead of the game. Dan, on the other hand, agreed and recommended they outsource the production and concentrate on their marketing. He preferred the firm to stay private thereby relying less on external capital and retaining control. And so Lisa and Joe want to take the company public along with, and Matt does too. Dan wants to keep the company private and outsource. And to me, I think you can work out, you can negotiate terms with an outsourced manufacturer, and you can control, you can keep formulas confidential, and you can control quality. So I do not agree with Lisa and Joe and Matt that there's a concern about outsourcing. Shouldn't be. The only concern I would have about outsourcing, and I mentioned it earlier, is that you lose control of your cost of goods sold. And your margins are going to get squeezed. Now, you negotiate that, but those things are renewed on a pretty regular basis, and you've got to pay the outsourcer. So unless the outsourcer has tremendous economies of scale and can manufacture at the same cost that you were able to that you were manufacturing internally, chances are they're going to manufacture at a similar cost that you were manufacturing at, plus they layer on a profit margin, so that will hammer your margins. Okay, so that would be my big concern, and that is what would have to work out in terms of outsourcing. Okay, now let's look at question number 2. Comment on Lisa's preference of the corporate value model based on her approach. What would Citrus Globe's selling price per share be if they were to issue 30 million shares? There's that number again, 30 million shares. So Lisa and Joe and Dan look at 3 different approaches. So what Lisa does is she's going to compute the total enterprise value of the company, subtract out the debt, and you come up with the total equity value of the company, which is different from owner's equity. We were talking about the market value of equity. And then you divide that by 30 million shares and you get a price per share. Let's see, Dan uses the multiples method, and then Joe wants to use the dividend discount model. And all 3 models have strengths and weaknesses. Typically, the corporate value model is used to value an entire company. And so I think since they're trying to raise capital, there's a difference between an analyst who is recommending to an individual investor what the stock price should be worth. That's where you use the multiple model. But when you're going to raise a bunch of capital, a significant amount of capital, you need to value the entire company. And to value the entire company, the discounted cash flow method, which is the corporate value model, is the preferred method. And all private equity firms, when they're thinking about making a significant investment in a company or buying 100% or control of a company, they use the corporate value model or the discounted cash flow model, same thing. All right, so dividend discount model and the multiple models used to help an individual investor decide when they're going to take a passive, small position in a stock. They use those models. All right, so with that, let's look. Lisa, on page 55, tells us exactly how she wants us to value the company. Okay? So we're going to have to estimate the discounted free cash flows, and free cash flows are equal to NOPAT minus net capital investment. Okay, so for 2000, let's go over and look at the financial statements. Let's see what we have here. Have that. Yeah, this is what I'm looking for here. let's go up here. And let's go to, bear with me for just a second. I thought I had, this is what I want. This is what I want. So let's look, we've got financial statements here. So we've got balance sheet here, okay? And we've got income statement here, so 2004, and we've got some key market data in here, okay? And all we're going to look at, well, we'll start, Lisa says, so compute the NOPAT less capital investment, which is the investment in property, plant, and equipment, for 2004, and then grow that 20% for 2005, 10% for 2006, and then in 2006 we'll go to a long-term constant growth rate of 6%. So this is supernormal to constant growth, okay? And then she gives us information about how to derive the cost of equity. She gives us the CAPM information, the risk-free rate, market risk premium, and the average beta of the three competitors to determine cost of equity. So she tells us exactly how she wants us to do the discounted cash flow. All right, so first, let's look at, and I know this thing, I don't know if I can flip this thing over or not, but you have this in front of you, the income statement, okay, for the last 5 years, and we're really going to focus more on 2004, okay, and so she says start with EBIT, so EBIT is right here. Here's EBIT, okay, which is earnings before interest and taxes, okay, and then multiply that by 1 minus the tax rate. So the tax rate is income taxes divided into pre-tax income, okay, so, and EBIT is pre-tax income. No, it's not. Here's EBIT right here. So we have 1, 2, so we have 1, 2. So here's our income taxes, and then here's our let's divide that into earnings before taxes, and we get a tax rate of 40%. $34,916,250 divided by $87,290,625 is 40%. So if we take EBIT times 1 minus the tax rate, we get our NOPAT. That's what NOPAT is. So let's flip over here, and we have EBIT here, right off the income statement. We have our tax rate that we just calculated, and we have EBIT times 1 minus the tax rate, and that gives us our NOPAT. From our NOPAT,